I think the difference that we have is that we're just a smaller shop, so we're able to deploy quicker and make quicker decisions. And then, of course, we're able to write smaller check sizes for very similar deals that is not necessarily competing against institutional capital because they're generally not playing in that space. And so, like the space we're playing in, generally, let's just say 1.5 million, 2 million on the low side, up to $7 million check sizes. We don't have a whole lot of competition, so we're able
Right.
to almost dictate our terms entirely the way we like.
Tim is one of the most authentic and genuine people I've ever
I
met.
sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Welcome, everyone, to today's Hero Capital Raising Show. I'm your host, Tim Mai. Today, we have a super special guest on the line with us. A lot of the guests we have on the line deals with the retail market that we're all used to. Our guest today, Sapan Talati, deals in his company, JT Capital, deals a lot with the institutional grade assets and institutional players. And so I'm super excited to interview Sapan today. He has been in the real estate business for 15 years now, has lots of experience across asset management, acquisitions, dispositions, strategies. At JT Capital, Sapan leads portfolio management and financing. As a company, check this out, guys. As a company in the last 15 years, they have transacted over $1.5 billion worth of capital. Yeah, they've raised over $350 million. They currently have over $500 million asset under management. That's because they were smart enough. They had Sapan must have had a crystal ball and exit a good portion of their portfolio in between 2020 to 2022. Right there at the height of the market when a lot of the syndicators in the industry were still heavily buying, and some even got themselves into trouble for the properties that they bought in 21 and 22. And so I am super excited to dig in and learn more about Sapan and his crystal ball, and then where he's going now with his funds. And so Sapan, with that, thank you so much for coming on this show with me today and sharing your knowledge with us today. Welcome.
Yeah, thank you. Thanks for having me. And hi, everybody. It's nice hearing all the introductions earlier.
Yeah, awesome. All right, well, let's start. If you can share with us a little bit about yourself and how did you get into this industry?
Yeah, sure. My intro into the industry is a little different, I think, than most folks. I kind of started off in the institutional world, was with BlackRock earlier on after college. Had a lot of exposure earlier on. Training kind of came from that, working then into private equity. Did some work for a family office. And then was eventually in management consulting, where my focus area was actually multifamily, more so on the loan portfolio side for large organizations. So had formal training from a slightly different, unique background, which then eventually led to more of the entrepreneurial route, right? Which then eventually led to JT Capital. So I've been in and out of the industry for a little bit longer than 15 years, but more focused in about 15 years.
I see. Well, very interesting. Yeah, I mean, fresh out of college working for BlackRock, that's amazing. That's an accomplishment in itself. So what was your background? What had you chose to work with BlackRock as your start into your career?
Yeah, I think probably like most folks out of college, you're not entirely sure what you want to do. You think you know what you want to do, and then a year or two later, a lot of that changes. And so that was for me pretty similar. I knew I wanted to be in real estate in some capacity. I'm not sure what really led me to that path, but that was just something that was just innate to me. And it wasn't so much of a drive towards I have to be in real estate, right? I was just passionate about it. I'd get my hands on just about any book I could read at that time. This is before social media became social media and before we really had Twitter, and you're able to follow folks and learn a bit more on how people are thinking about it. But rather, you go to Barnes and Nobles, you pick up some books, you go find things about that, or you go pick up textbooks. And for me, it was just fascinating. I remember. I learned a lot from realtors back then, driving around, looking at smaller assets. You're talking about 15, 20 unit complexes, if you want to call them complex. I was living outside of Philadelphia before I moved to New York City. And so that was a lot of my exposure. Then I got into the development world. And so I was doing some fundraising on that side. We're doing international development. And
Mm,
that was probably my first real like foot in the door, so to speak, in the real estate
mhm,
world, where I started getting actual experience. And then, yeah, from there, it was just that focus area of just basically learning every different aspect of running a business, not even real estate, just a business. And you start picking up on that, especially, management consulting. You're expected to be an expert in the very different practice areas that you're sitting there talking to, seniors and I'd say C-suite individuals when you're in your early and mid 20s. And so from there, then you start picking up different ways to look at solving a problem. There's more than one way of solving a problem. And so, ultimately, I was able to combine my passion with a lot of the tools I'd picked up, a lot of the skills I've been honing in on. And of course, we're always a student to our trade. So you're always learning as a market shift, right? We love learning about history, especially in my case. I love the history of multifamily, love looking at different market cycles. How's that applicable? And then expanding a little bit beyond that in terms of how the economic cycles could potentially impact maybe your investment strategy or your investment thesis over a 5 or 10 year horizon, and then how do you apply that? So, long-winded
very.
answer, but that's really how I got into it.
That's good. Very fascinating. I know the type of properties that you're dealing with now are very different probably than the one you started with. So share with us like what, the deals that you have been doing the last 15 years prior to now with the kind of deals that you're focusing now with your fund. Share with us the type of deals that you have done. And yeah, let's start with that.
Yeah, I think it's important to understand different types of deals, what works for you, what doesn't work for you, and then where do you want to. So I think this will vary from individual to individual, group to group. For us at JT, we're a big believer in understanding your niche or niche, and in really being so good at it. And so, one example I use is we'll identify one, two, or three different markets that we can really get deep in the weeds on, where we know it better than just
Mm,
pulling up maybe a CoStar report or a Yardi report or other databases that we're all subscribed to, where we're looking at analytics. Where I'm getting at is you want to be able to understand how to one, you see the data, but how to infer from it. What does that mean? If you see a Costco that's being built, understanding that that could go up, I'm going to generalize maybe 6 months from day one when when they break ground. Well, what kind of demographics did Costco, for example, are they analyzing? Who's their target audience? Does that fit
mm,
with the multifamily asset you're buying? And then what's the single family home count there? What's the supply demand? And so you're able to create a story or a narrative where you can get comfortable. Well, I think a lot of that isn't just looking at reports, but also understanding that market, the inflow, outflow of traffic. And so for us, we focused on certain markets that we feel we've been confident enough in when we want to invest in something, or if it's not necessarily investing, but just looking at it, observing, because we're anticipating something in the near future that we may want to be involved in, whether it's development or maybe in our fund standpoint, where we're comfortable to invest into that. In terms of classes, so initially we were involved in, B class, I'd say mid 80s, nothing much older than that, but our vintage focus is generally 2000s and newer. We found that to be our sweet spot. And we've built the team in such a way where I'm talking about our extended team, that we're able to better, I would say, solve maybe the need, solve the problem, and then really look for that outcome. Completely different way of managing different asset classes. And so rather than saying, yeah, we'll focus on classes A and B, or maybe even C, we wanted to focus on 2000 newer vintage. Different market,
I
I would
see.
say, also play a role into that, where, prior to COVID, I'd say more of that value add mid 80s or even 90s vintage offered more upside while also understanding deferred maintenance. Then we got into that COVID period where it didn't matter about deferred maintenance because rents were going up significantly in some places 30, 40, 48%. I've seen that even down in Miami, where you wanted to focus on the renovation side of it, so you can just capture that rent, because
Mm,
deferred maintenance wasn't going to get you that rent pop. And so then you didn't want to really acquire assets that necessarily had a lot of that deferred maintenance, even if the cost basis was good, because you were able to quickly flip in and flip out of that. While that wasn't part of our business model, it was just observations we had of the market at that time. And it was roughly around then where we had decided largely we felt more comfortable on the sidelines.
So let's go into that. So what was your crystal ball telling you? What was the data telling you that you felt like, okay, this is time for us to get out, get on the sideline?
Sure. I think for us, I mean, not a crystal ball. I'd love to have one. There's really just a negative leverage component of it. We just felt largely uncomfortable where, certain markets we've been looking at for a long time. Austin, where we've got a strong presence in, at least in terms of our team. We don't have a strong presence in terms of acquisitions. We've got one asset out there. We've been looking at that market for a long time. We've just simply been outbid on everything. Tampa's another
Mm,
market. We've made a number of bids on a number of assets. We've yet to close on a single deal out in Tampa just because we couldn't get the pricing we wanted. And so, for us, we're entirely okay with losing out on bids. We're fine with that. We just don't want to acquire that one deal that we really wanted, and then we realized we overpaid for it. So we'd rather come in under, and that's where we've been. In terms of crystal ball, no crystal ball. It's just we couldn't get comfortable with that negative leverage side standpoint, and then of course, then there's a lot of that unknown where we started seeing the rates going up a lot quicker than we've probably seen historically. So that left us a little uncomfortable as well. Which interesting enough, we did do one deal mid-year 2022, got under contract earlier, and we were doing an in the money rate cap when rate caps were really cheap. We ended up going with 50 basis points, and I remember at that time the lender wanted to pull out because we decided to go in with such a low rate cap. It just was unheard of. But for us, it was really just the data behind that we couldn't get behind, where we're saying, look, it doesn't support anything that we've seen, and we're not comfortable. So either we're doing it at this rate cap, or we're just going to walk from the deal entirely. And so that kind of goes back to we do a lot of data driven decisions with stand behind it, but at the same time, with that, if there's certain uncertainties, we'll kind of look at more from a risk protection or capital protection, principal preservation standpoint, and less so on the upside. We'd rather get a lower yield. And I've always said risk adjusted return. So, instead of going for that 20% yield as an example, I'd rather get 13% because I'll look at it from a risk adjusted standpoint. And so that's just always been our belief. That's always been what we've followed, our motto, and that's how we'll make investment decisions.
right. And how did you guys know? Because I know you guys exit a number of your properties doing, from that COVID, from 2020 to 2022 there. How did you know that was time to exit? I mean, your timing couldn't have been any better. So
Sure.
yeah,
I think it wasn't so much just playing out timing. We had a lot of fixed rate deals, so we weren't really pushed by the fact that rates were going up. I think it was just more, we've just seen a significant increase in pricing where it just made sense to capitalize on it and
I
exit.
see.
While the duration of the remaining loans, either it was attractive from an assumption standpoint, or at that time there's a lot of competition with the floating rates, and so we were seeing a lot of folks out there willing to pay more than maybe the market supported. Right, we were in a very frothy market, and so a lot of those things just made it easier to decide on. Look, if we can get a healthy return, even in some cases prematurely, we're enabling our LPs to reinvest into other assets, or maybe with different groups, or wherever they may need to rebalance their portfolio. That made a lot more sense to us, rather
Mm,
than um, holding on to it for a few more years or even another year beyond that. The thought wasn't the market's getting to a point where it's at this tipping edge. We weren't looking at it from that angle. So we look at each asset specific to its own asset performance. Why we didn't get back into the market was really just exactly what I said, right? There are
I
people
see.
paying a lot more. And I think the telltale was we were losing out on deals, not by just a little. We started losing out on deals even by seven figures. And then it got to a point where you had to put a significant amount of non-refundable down. And it was just so
Yeah,
competitive that we wanted to take a step back. We wanted to just see how some of this played out. And then most importantly, just see where ultimately the interest rates would start to flatten out, or we'd see some light at the end of the tunnel. I know a lot of us just play crystal ball with it. And so we were enjoying the conversation more than the stress of, when do we need to lock and optimize it? And so that was really our approach towards it. And then while we've been doing that, we kind of led into the fund where we've been looking at opportunities instead of doing single asset acquisitions. While that's great, maybe the current market cycle is better not to do that unless you're finding distressed situations.
Yeah, gotcha. All right, so let's talk about the market now.
Sure.
And then, like for you to share, yeah, what are you seeing in the market now? Where you see the opportunities are? Yeah.
Yeah, it's an interesting market, out there. I think, last year was probably one of the toughest years to find a good deal, right? And, we've all talked about price discovery. The bid ask was so wide, right? Sellers wanted more than what buyers were willing to pay for. I think the interesting thing is that of the deals we've seen in terms of transactions, we've seen a lot of them just transact privately. Whether it was a fund, you may have two multiple funds, Fund A buying it or Fund B buying it from Fund A, and you're able to recap on your own deal, or you're just seeing some private transactions that's basically getting us to where they wanted to be. And then the deals we're seeing on the market were not necessarily deals we wanted to acquire. Maybe there was a great cost basis with the seller, and they were able to take a haircut and then bring it to market, and that was the end of their cycle on that asset. Some deals we saw out to market, they just honestly had run through their mandate in terms of maybe it was a fund owned asset, and it was time for them to sell. And then you saw some distress stuff, but we just didn't see a whole lot of volume. And so it's really difficult to put a true price, hence price discovery on what this is valued. I'm kind of in the believer that the cap rates in the present market aren't necessarily where ultimately the value of the asset is. I think there's
Hmm.
probably about 25 to 50 bips lower than where we're currently seeing transactions in terms of real asset pricing. That doesn't necessarily mean we're going to capture that if you bring a deal out to market today. But I think that could be applied to a lot of deals that are transacting on a private level, and so we're not really seeing that asset pricing. I think this year we're a lot better adept to get closer to that price discovery, and we'll see more transaction volume. I think we're going to see better deals coming out to market because of that. And more so, we're just going to see a lot of folks that are still just trying to kick the can down the road, trying to do that refinance, and largely banking on the Fed rates being cut, right? Whether it's mid-year or later this year, or in some maybe not at all, right? And I think that's not necessarily a prudent move. Either you're refinancing because it's making sense, but try not to kick that can down the road. And we could talk more about why I think rates may even stay flat. But again, I don't have a crystal ball on that, but that's just how we're approaching the market, because we'd rather be conservative on that, and we underwrite to the rates staying where they're at as opposed to where they may be coming down to.
Right. And we're going to talk about your fund in just a little bit here and your
Mhm.
strategy with that. But before we go there,
Sure.
in this market, do you see this opportunity for acquisitions right now? Because some people are saying, they're expecting the market to continue to, to go down, and,
Mhm.
rent is still, negative right now. So can you speak into that? Like, is this
Sure.
year, do you see opportunity to actually acquire property this year, or more, into 2025?
That's a great question. I think it depends on your investment thesis. I'm still seeing the best deals out there for the groups that are able to do assumptions. New debt today, I don't see it pricing to where the sellers are looking to price it at, unless it's a one-off situation. I think, when I'm looking at, or when we're modeling out stuff, at least for us, the assumption deals are the best deals if we were to do an assumption. So that being said, no, we're not doing single asset acquisitions today. We're just not seeing the pricing we'd like to. That doesn't mean we're not underwriting those deals. That doesn't mean we're making bids on those deals. We're just coming in significantly below where I think the seller would like to see it. And again, this is market specific. There's some markets out there where that may not be true, right? We're mostly in the Sun Belt, and so for us, we're underwriting to increase in insurance. We're still expecting another 25-30% increase this year from year over
Mm,
year on the insurance, and then the following years coming in. So we're looking at that. So that's playing a role in our underwriting. It may or may not be true with how the seller is looking at it, but that's largely why we have not been able to find pricing that works for us on a single asset acquisition, and we don't expect that this year. But you never know. You may come across something that does make sense. There's markets out there we're seeing where rent's still growing. We're not seeing supply being a big shock. And so those markets, you got to look at it. Okay, it's great for this year, maybe next year in terms of rent growth. Is that how it's going to be maybe during my hold period? Whereas some of those markets right now, where we're seeing softening of the rent market because of the supply shock, which we're depending on where you're at, maybe the tail end of it. Am I able to absorb that for the next 18, 24 months? And then do I want to hold on to this another 5 years after because I believe in the submarket, right? So there's ebbs and flows where it depends on your investment thesis. A lot of times we just want cash flow from day one. Some assets may not give you that, and it may be okay where you're really looking at it from the value perspective over the longer midterm range.
I see. So let's talk about your fund and
Sure.
how, yeah, like what, yeah, how your fund structured, the type of assets you guys go after. Give us an overview.
Sure. Overview, similar types of assets that we would buy, 2000 and newer vintage predominantly. We looked at it as, can we achieve good diversification instead of buying one or two single assets, today? And our goal was to go after 18 to 22, 23 different assets at once, achieve good diversification, get good allocation into it, and then also be in a better position on the capital stack. Example, I buy a deal today. If it was to come down even 5%, let's just say, then I've essentially eroded 5% of my value. I've eroded, and that value is coming directly off of our invested capital on a one-to-one basis, right? We go into a higher position within the capital stack, and there's a nice equity cushion. Even if it say value came down 20%, and just kind of using some broader numbers here, we're still in a position where we still have 100% of our invested capital, right? That's just more from that risk perspective. Then we're selectively looking at the geographies. We're selectively looking at which operators we want to be invested with, working with. We're looking at the deals themselves. I kind of liken it to, Tim, let's say you approached me and you said, hey, I've got a great deal. And I said, you know what? I like your deal a lot. Come to me in 2 years after you've acquired it, and then I'll still make my investment decision after that. Well, now I've had 2 years to essentially see how you've managed it, how you've operated. I'll get to see what kind of borrower have you been? Are you current on your payments? What kind of relationship do you have with your lender? And I get to see how you've executed on your business plan. And so I've got a lot of 2020 vision. Now, of course, the fund, not everything's always 2020, but we have a lot more data. We have a lot more insights into who you are. We've got like a 18, 20 page due diligence document on you and who you are as a sponsor, where we're really getting into the weeds. And then the other thing is we're only involved with folks that, have a very, I'd say, solid track record. For example, we've been looking at deals with some of these folks have, well over 5-10 billion, dollars under management currently and
Wow.
presently. And so for them, it's not a capital call. It's more of a business decision, right? That's one thing I wanted to just kind of provide the distinction is we're not looking for deals where these folks need capital calls and they don't have the capital. We're looking at deals where they have that capital. But this is more of a business decision to finance certain things for the short-term duration. What I like a lot is we're coming in with expensive money, but at the same time, we're looking at maybe converting into an equity position at a disproportionate rate, meaning, okay, you bought a deal at say 80 million in 2021. Maybe it's valued at 55 or 60 million today. We're buying it at a discount on today's value. So really it's a discount on your par from 2021. And we want that
Mm.
discount because we're not participating in your cost segregation, that you had 2-3 years ago. And by the way, we're going to price it based on today's dollars. So effectively, we're converting at in the money. And then on top of that, we're coming in as a true JV equity. So we're getting seniority on the equity and then, of course, the control rights that come with it. So we like that position. We like the ability to be more diverse across 18 to 20 assets. And then these are in markets that we're very comfortable in. I think one of the things is, as being an owner operator, we also have the ability to coming in and managing it. Part of our business that we don't market or we don't really push is that We asset manage for high net worth folks and other family offices. So we have that ability already in-house, where we've got dedicated team members to specifically managing on the asset management side, not just for us internally, but also externally.
Right, gotcha. All right, let me make sure that I understand and clarify for the audience as well. So is your funds, and I'm using the term rescue loosely here, but
Sure, sure,
yeah,
sure.
yeah, it's kind of like a debt fund, rescue fund. You're coming in to give the operator a cash injection, and then that investment that you're making in on the capital stack sits kind of like at a pref ec position above the common equity. Is that correct?
Yeah, so it's in some ways. Legal structure could vary based on the deal. Like all pref equity out there, you're not really pref equity unless your senior note, one approves of it and you have a subordination agreement in place. Because most senior lenders, if not all, would require the sponsor or the borrower to get approval before they take on additional debt, right? Like you can't take on more debt. It's in your loan covenant. So you can't come in as pref equity unless it's already been approved. And then you want that subordination agreement. And so in some cases, we're coming in under that covenant, we're getting that subordination agreement. In most cases, because we're looking for that upside, we prefer to just come in as equity. But
I
we're
see.
senior to the common equity that's already
I
in place.
see.
And then we have stringent requirements, right? Like we absolutely want control rights. We want the ability to drag a deal out to market because lack of performance. We want the ability to say no if you're looking at selling it prematurely. Like we want to have these covenants in place because at the end of the day, we're looking for principal protection on our equity. And it's not that we want to come in as predatory, but we're looking at principal protection. We're looking at downside protection first before we're looking at the upside. So it's a different market cycle. And then with the fund, it's less so the emphasis on the upside because we feel like we've already captured some of that coming in on that senior side. We captured it because we're coming in on a discount to par, and then further the discount based on today's value. And of course, we're going to have some minimum requirements in terms of the minimum return, right? Before any of the LP, and when we refer to LP, we're talking about more of the sponsor borrower and their LPs. So before they're paid out, we want to make sure the fund is receiving its minimum required rate of return on an annualized basis on any conversion. So that's one of the reasons we really like it. We're looking at it as it's similar to an institution deploying into an opportunity, if you will. I think the difference that we have is that we're just a smaller shop. So we're able to deploy quicker and make quicker decisions. And then, of course, we're able to write smaller check sizes for very similar deals that is not necessarily competing against institutional capital because they're generally not playing in that space. And so like the space we're playing in generally, let's just say $1.5 million, $2 million on the low side up to $7 million check sizes. We don't have a whole lot of competition. So we're able
Right.
to almost dictate our terms entirely the way we like. And so it's unlike acquiring a single asset, you have a lot of competition. People are trying to buy and they're bidding up the price. In this case, we have a lot of deals to select from and we don't really have a lot of competition. So we're basically just
I see.
dictating our terms.
All right. So I want to dive a little deeper here because you're doing two things. I'm hearing you're doing two things that's different from what you were doing before. So number one is that you're not coming in as a new acquisition, acquiring the assets, like JT Capital acquiring the assets, managing the assets, but instead you're coming into an existing operations, existing business, and you're giving them a cash injection. So that's one part that you do, and then this that's different. Sounds like different from what you were doing before. And then the second part that's different is you're now doing it in a fund structure instead of a one-off syndication. So can we dig further into both of those? So
Yes.
what have you choose to not acquire these outright and have your company manage them entirely versus giving them a cash injection and partnering in on the deal?
Sure. So let me just go back to we're selecting operators that have a good track record, right? They have in some cases thousands of doors under management, and they have the ability to manage it. For them, it's just more a business decision, partly because we've seen some of that cap stack being vacated by small to medium-sized banks. I think one thing I'll mention, what's interesting, is that the Bank Term Funding Program expiring March 11th. I think some folks have heard of it. And that was largely a facility put in place about a year ago when Sovereign National Bank was having its own challenges and essentially went under, and then some other ones, right? And now we've seen NYCB kind of make the headlines. I think with that facility expiring next month, well, I say interesting because that could be a result of further lack of liquidity in the marketplace, at least from these banks. So you're seeing further gap or retrieval of money or funding from the bank side, right? And so that's that opportunity for us and other groups to kind of fulfill that portion of the cap stack. And so we're seeing that as one of the opportunities, but within that, I caution, we're not looking to work with folks that absolutely need the capital from a rescue standpoint. We're looking to work with folks that don't need it. Can they
Yeah.
self-fund? Absolutely. And so but for them, it's a business decision on, our returns make more sense because we're going to go seek out that form in some type of, either we're going to give up equity or we're just going to finance it. An example could be a rate cap. Some groups are extending the rate cap. They can very well fund it. Maybe we come in and we'll finance that rate cap for 12 months. Maybe for 20% plus some additional, 1 point in, 1 point out. We're seeing a market for that. 16% is probably also more in line, but we're seeing folks paying a little bit more on that. And then we're banking on the fact that the market isn't going to change significantly. And even if it does, right? Let's say even if it does, for our fund size being smaller, we didn't want to do a large fund because what we want to do is be able to deploy this capital quickly, put it to work. We don't want to be in a position where we have all this capital and now you're making decisions because you have to place it, right? So our thought was, look, this is the right size fund. We're able to capitalize on what we're seeing over the Q2, Q3, potentially even into Q4. Because even if let's just say Fed funds cut rates in June by 50 bips, right? I don't expect that, but let's just say they did, and they did it again. It's not going to fix what's going on in the marketplace. There's a number of deals that are upside down that are going to have a lot of challenges to I'd say refi in. We're not necessarily looking for those particular deals, right? Those are going to be there. We're just looking at for the deals that have a solid business plan where we can capture good upside equity in that middle of the capital stack. And so it's a smaller check size. We don't want to exceed 70 LTV. I know 80, 85 is what I'm hearing from some groups. We just don't want to go above 70. We still don't know where this market's going to shake out. So with our equity plus the senior, we want to stay south of 70 LTV. We feel comfortable. It gives us good downside risk protection because if for whatever reason it's not performing, we can still get out with our principal and even our return. At the same time, we like that upside potential. Acquiring a deal today, going back to, we're not finding the pricing we want. And so I'd rather be in that middle of the capital stack where I've got more certainty around my return, especially if I can get 16, 18, 20% without the same risks of owning a deal. That's much better than owning a deal today. That's how we're looking at it.
I see. Very fascinating. How much is the total fund amount that you're raising for?
Yeah, so we're kind of looking in that 50 to 75 million space.
50, okay.
We've probably been out about 2-3 days. This week we're officially going out to market with it. And we've probably got half of it committed from some large folks. And then, we're also working with our existing base of groups as well. But I'm not on that capital market side, so I can get you better updates afterwards. But yeah, it's an exciting, I think, time really to look at acquiring or investing into real estate in general, especially multifamily, given what's going on. We're seeing a lot of larger groups now looking for similar opportunities, just different check sizes,
Right.
because of where we're at. Yeah.
Gotcha. Okay. I know you mentioned you're not managing the market, the capital market side, but I'm just curious in terms of
Yeah,
your investor type that was investing with you in the past through with your
sure.
syndication versus the investors you guys are going after now for the fund. Is it still the same investor base? Is there anything different, or is any of your investors saying, well, I only want to do like deal by deal, syndications. I'm not looking to invest in the fund, at least not this first fund. Are you having that
Sure.
kind of conversation?
Yeah, great question. So we're still talking the same type of investor base. We've got some family offices that come in on many of our deals, write large checks. And then we've got several high net worth folks, similar, right? Writing some large checks, and then we have our in between. We've got the retail investor as well. Very few have come back and asked us, why the fund versus maybe these one-offs. And I only want to do the one-off. We've had a few come back ask about that, and I think it's really just a function of education, of helping them understand. One, you're achieving diversification, but two, for this present market cycle, here's why this makes sense, and here's why we're doing this versus focusing on single asset acquisition. May or may not be right for you. It really depends on what you're seeking out for yourself, right? For your own investment. And then, kind of like timeline and return metrics as well. I've always said we're not going to be your highest yield shop. We're just more focused on just really good investments that have that risk adjusted return. So, as I mentioned earlier, we'll gladly take a little bit of a lower return, but we just want to have less risk exposure, and especially in uncertain markets like today. And so that's how we've always made our investment decisions, and that's how we'll continue to make our decisions too going forward.
Right. That's awesome. In terms of the family offices,
Mhm.
with now with the fund focusing on more institutional grade multifamily assets, are you attracting more family offices because of the type of assets you're going after now versus like the sort of the not institutional, the
Sure,
retail
sure.
type
That's
assets?
broad-based question in the sense of, so we recently, right, we've seen a number of family offices grow significantly where they themselves are almost institutional. They've got their own
Mm,
teams, they've got their own credit teams, they have their own analysts. There's just been a massive growth in wealth within the family office space. Then there's a segment of family offices where it doesn't make sense for them to invest into another fund, because really then they just become like the managers are just kind of in that spot of like, why'd they hire me? Because I'm supposed to go out and seek these opportunities, right? Not just go find other funds to invest into. So those are, I'd say those two buckets of family offices are not really who we're having engaging conversations with, particularly to our current investment opportunities. There's a number of family offices that don't have a significant amount of real estate exposure. We're great for that. And then there's some we've had relationships with for a number of years, and so that just is a different conversation. But yeah, I think while family offices are great, there's also the high net worth folks, and then there's I'd say more the individual that qualifies for 506c, right? They're accredited,
right.
don't know a whole lot, or they do know a whole lot, and they just, it's just a conversation of understanding why they really want to be in multifamily, what they're looking for, and just getting them comfortable with who we are. And in some cases, they may be looking for a different type of exposure, maybe a different part of the country, or maybe not multifamily as a whole. We're trying to achieve with this. It's almost like investing in I'd say like an ETF, right? You don't want to be just in multifamily. You don't want to just be in Class A, maybe in say Atlanta or New York, but you're looking to be in several different states, right? And having different types of exposure across different folks who have a good track record. And largely one thing I was going to say is that the fund's not predominantly investing in syndicated deals. We've been looking more in smaller groups of syndicators, or just generally multimillionaires that have been doing this for 20, 30 years in some cases. have amassed a massive portfolio of multifamily and other commercial real estate. That just, it makes more sense for them to go ahead
Mm,
and take our investment. We're kind of just focused on less risk exposure is really our thing. We're not looking for deals that if we don't fund it in the next 2 months, they're at risk of losing their asset. That's just
mhm.
not something we want to even be involved in.
Right. Family office side, I know
Mhm.
there's a number of people listening in interested in establishing relationship with family offices and start working more with the family offices. What are some of your recommendations for them in terms of where they can go to find family offices, like events, or ways that some tips that you might have for people looking
Sure.
to start getting into that direction?
Yeah, I think the biggest one is really just conferences where you have strong family office presence, at least to meet them and have conversations with them. There's a lot of them out there, and a lot of them are looking for different types of organizations to work with. In many cases, you may or may not be the right fit. Just depends on what they're looking for, and so it's hard to really pinpoint to one thing, just because there's so many
I
out
see.
there, so many different but that's generally where we've met a bunch. Recommendations and referrals have been another, for the most part. And yeah, I've been doing this for a long time, so I have a lot of relationships. So
Right.
that's been helpful because that just led to other introductions over a period of time. But I'd say conferences and I think ones that are really targeting family offices are the ones you may want to go to, especially if you're trying to get in this area. And then of course just be mindful, that first
Right.
conversation is not going to yield maybe an investment. And in some cases
Right.
it could be several years. Like I've had conversations with some folks for 2, 3 years and we didn't, get a single check from them, but we also didn't ask.
Mhm.
But it's just one of those relationships you nurture over a period of time. Make sure you have something to
Right.
offer that's useful for them because it's not about you. And if that ultimately turns into an investment relationship, great. If not, that's okay because sometimes they may just refer you to other folks that are just a better fit.
Right. Can you share with us a couple of names of events? Because I've been to a couple of different ones that claims
Mhm.
to focus on family offices, but when I was there, there's not much family offices. A bunch of like us
Right.
operators there trying to look for family offices. What are some like a couple that you think of your top of your head that has a good amount of family offices actually there?
Sure. Well, there's one we're going to in June. The IMN conference out here in Laguna is a good
Oh,
one.
okay.
Yeah, they put on a good event. We've been going to it for a number of years on and off, and I've always found that to be one very useful in terms of the panelists that are out there across the different sessions. But the networking component's been just fantastic.
I see.
Another private family office event over in Miami. That's also mid-year. I can't remember the name off the top of my head, and I can, happy to email it to you, and you can share it with your audience as
Okay.
well.
Any other ones that you can like one more that you can think of a name for right now?
Um, Let me email you that one as well.
Okay. All right.
There's a couple that we used to attend. We haven't attended in some time.
Okay.
But yeah, definitely will rack my brain on one or two that
Yeah.
might be useful for your team.
Person in the chat put Opal. Are they a good one? Opal.
Opal.
Yeah,
I
like the conference, the group.
yeah. I haven't been to that one, so I can't
Oh, okay.
comment on
Gotcha.
that.
Okay. Got
Yeah.
it. Okay.
Yeah,
Cool.
no, and
And then
honestly, what I
go
was
ahead.
gonna say is there's a number of events that they're not necessarily big conferences, right? But just locally, especially if you live in LA. So I'm in Southern California, in New York. I'll go to these. They're not a true conference, but it's just more of a like a networking event. A lot of times you'll just meet the folks that are tuned in or maybe working at one. And so those are good events, a lot of times more personable. As I say, just try to meet somebody or go through your network that might already be in that space where if you can tag along or maybe get some introductions, that would be useful. I found that to be helpful as well, especially earlier on in my career. I used to go to a lot of these private equity events, and from there I met a lot of the guys that used to be in the PE world, now running different family offices. So
Okay.
that's helpful too.
Gotcha. And I know you guys are also looking for a fund of funds as well.
Mhm.
What's yeah, so because there's some people on the line here do have fund of funds. So share with us, what are you looking for from that perspective? Ideally, how much money you'd like to see them, bring into invest into your fund.
Yeah. I'm not sure about an ideal, right? We just look at it as, is our fund the right fit for a fund that's looking to maybe place capital into, or where are they looking to deploy, right?
Mm-hmm.
Is that something that's going to work for their investors? And so I look at it as we can have that conversation with anybody that is interested, in the sense of, what kind of return hurdles or metrics are they looking for? What are we investing into? And we can get more in detail, a lot more detail than we're on this conversation. And really just see if that's a good fit for them. Because it's not about us, right? Like I've said, it's really about making sure that what we're currently offering through the fund really fits maybe that fund of funds criteria of where they want to deploy the capital, and are they comfortable from that standpoint. We've seen some groups come in, like investment clubs will get together, and they'll invest into us. And then we've had some large institutions come in. While we're not marketing actively to institutions, we've had large institutional checks as well.
Gotcha. I have another question. And this applies both at your level,
Mhm.
at your fund level, as well as the fund of funds level. Um, each time that you identify a property that you're going to invest in, do
Mhm.
you utilize that property to market for the fund as basically like you're like, okay, we're about to invest in this particular asset. So this gives you an example of the type of assets that the fund invests in. And so you utilize that specific asset to then raise money for the fund. And then on the fund of funds level, they can also, because one of the
Yeah,
hardest thing, the transition between raising for syndications versus raising for funds is that lack of transparency of a specific
sure.
asset that the investors, the LPs can tangibly
Yeah.
connect to, right? Yeah.
Yeah. No, I totally get it. So I like how you positioned it, right? One of the challenges with today's market is that going back to like why we kept it smaller too in general, is that the competitive advantage is being able to deploy the capital quick today, right? Because we see a small window of opportunity that we think is very unique for some large upside, disproportionate, value that we can capture. And as much as I like to say, oh, we're going to get this X amount, that just seems way too high. We're looking at some of that, and we're not going to market that. But at the same time, if we were to say, these are deals we've invested into, and we're going to continue raising, largely we know internally we've missed the boat, because that would mean that we're essentially raising 8 months out from now, and we don't want to be. But one of the things we have done is there's a number of deals that we've simply said no to, that I think, if not specifically to what we're looking for in the fund, may have even made good sense for the to invest into. And so that might be a fun conversation, we can have even after this. I can share with you a lot of deals that we've just basically said no to, we've walked away from. These are good operators, they, great position, looking for capital just to fulfill maybe from 62 to 65 on the LTV. They had the remaining 35% equity in the deal, significant, equity cushion for us, was willing to pay us a pretty good return on it, fixed rate return. We just didn't feel there was enough upside. And while it would have fulfilled maybe even the pref return on our fund, I have a feeling most folks are not investing in the fund just for the pref return, right? And so, but it's a very good risk adjusted, return. It just doesn't make sense for this fund. So I think maybe just taking your question as to what we've invested into, sometimes it's what have we not invested into may actually be more beneficial for folks to understand, of like, we've walked away from some significant or several high quality deals. I think it just didn't fit the fund bucket.
I see. For the folks that wants to invest with you, whether as an LP or the fund managers that want to invest with you as a fund of funds, where would you like to send them? Or yeah, they just want to connect with your organization, learn more about your fund. Where would you like to send them?
Hey, the easiest is just go visit us at JT Capital. So jtcapitalgroup.com.
Okay, awesome. All right, Sapan, thank you so much for doing this interview with me. Really appreciate you. You've been such a wealth amount of knowledge,
Oh,
and
thanks,
yeah, I
Tim.
love
Appreciate it.
I love the flow of your answers, and I was able to get in a lot of questions as well. So
Cool.
thank you
Yeah,
so much.
appreciate it. No, thank you.